Good evening, ladies and gentlemen, and welcome to our webinar on technical analysis on candlestick charts. Tonight's class is sponsored by Alvexo, one of the leading Forex and CFD providers in the world. And when you trade with Alvexo, you know you're trading with a very safe and well-known company. They hold many regulations around the world, depending on whether you're in Europe, in Asia, in the Middle East. Alvexo holds licenses throughout the globe, and therefore you know you're trading with a regulated provider. They also offer fantastic trading on their platform. You can use their web trader, which is their online internet platform. You simply use your username and password and log in, and you can start trading there with real-time quotes, all types of order execution types, and high-speed execution, faster than most platforms in the world, with incredible security and a broad range of assets. You can also download their MT4 platform for those of you who want a more professional environment. You have many types of execution types, including market orders, limit orders, stop loss orders, trailing stop orders. You have some of the most advanced charts, and you can customize and set up these charts the way you want them to be. And you can also attach automated trading, or build your own automated trading system with it, and also all the advanced experts can be attached to the platform. They also give you live up-to-the-minute signals that have 88% accuracy, and they're free of charge, and they're pushed right out to your platform. Now, they are the sponsor of tonight's class, so you can go visit them at www.alvexo.com. And while we're in class, you can open up a demo account. You can romp around, see what's going on with them, decide if you want to even start trading with them. But they are a great platform. Now, tonight's class is being recorded, and you can locate the recording of this class in about 24 hours by going to www.investing.com, where you sign up for the class, and go look for the Education tab, and then go find Webinars on Demand, and you can watch this class or all of our other classes available right there on the investing.com website. Remember, it'll take about 24 hours for this class to be uploaded, but there's many other classes for you there to select from. So let's get started talking about technical analysis. Now, traders who subscribe to technical analysis operate under the fundamental theory that price moves in patterns and that price never lies. And its price is the ultimate dominating factor that no one can ignore. You must always keep a look on price. Now, you find all of this, whether it's price action, whether it's a type of charts or candlesticks or with technical analysis, you'll find this on your charts. And to inexperienced eye, a financial chart may look like an unpredictable line with jumbles of colors and marks. But these traders are watching charts to pick up the subtlest of indicators and where share or asset prices could be headed next. So let's take a look at the breakdown of the common types of technical indicators that traders are looking for and watching for. Now, the main similarity between technical analysis indicators is that they all use security prices, the up, the open, the high, the low, and the close in volume in their calculations. The small number of variables has produced hundreds and even thousands of different types of indicators. Now, there's a small group of those that are well known and preferred, but there's lots and lots of stuff out there that you could adapt or use or learn about. Now, technical indicators fall mainly into two categories, what we call leading and lagging. And this is very important to understand because different types of indicators will support different types of information for you. They'll support different types of decisions. Now, leading indicators are those who lead the price movement. They give a signal before a new trend or reversal occurs. Lagging indicators are those who follow price action, and they give a signal after trend or reversal has occurred. So in other words, a leading indicator will tell you that a new trend is about to start. where a lagging indicator will indicate to you that the previous trend is over and ended, or a new trend has already begun. So indicators from both categories belong to one of the following types. Now we can break down all of these indicators into 4 categories. Now each of these categories have two separations, leading and lagging, but they all will fall under either trend, momentum, volatility, and volume. Now it's important to understand where your indicators lie, where they fall, because the thing is, you don't want to be using multiple indicators that fit just one type of category. You want to understand what the data is you're getting and what they're filling. A good strategy uses a little bit of this, a little bit of that, a little bit of this, instead of using a lot of that. And you have to understand whether your indicators are supporting your decision or telling you something's about to change. So the first major category are trend indicators. Now, identifying trends over time frames are useful because it will help weed out all the noise in the daily volatility. Any type of trend, including uptrends, downtrends, and sideways trends, can be traded for profit as long as it's shown itself to be consistent. Now, most people say, in a sideways trend, what is that? Well, that's when price is moving in a range. But some of your best trading will come out of range trading, because if price is moving sideways, there's still going to be a top and a bottom. And every time it bumps up to that top level, you can trade it to go down because it's just bumping up and down, up and down. So it doesn't have much volatility in it, but it can offer very good profit scenarios. Trend traders use a number of different indicators to help them figure out what kind of trend an asset is in. One of the most popular of these indicators is simply moving averages. Now, moving averages represented by a single line that represents a stock's or an asset's average price over a given period of time. Now, by combining 2 moving averages, say for instance a 50 and a 200 day, or a 30 and a 60, or a 10 and a 20, there's all types of different strategies. You're always using one longer period and one shorter period, but these will give you great strategies. And a moving average is actually an indicator. Now, other examples of trend indicators include my favorite of all time, moving average convergence and divergence, referred to as MACD, or ADI, average directional index, or linear regression. But the next question is, which do they do? Do they predict the markets, or do they lag behind the markets? Now, the next popular category is what we call volume. Volume, of course, is the measure of the total number of shares or contracts that trade in a given period of time. Where volume really comes in handy is for confirmation. Now, most traders ignore volume, and they don't understand that volume itself is one of the most supportive indicators, because when you expect a trend to be going up or down, or an indicator to tell you it's an entry or exit point, you should see the rest of the market moving along with that. So if the price of an asset is moving up steady and coming to, say, a support line or resistance line, and if you think it's going to have the momentum to break through it, you should see volume increasing. If you see volume easing off, if it's getting to that resistance line, most likely it's going to bounce up. It doesn't mean it can't go through, but it tells you the market isn't very strong about it. Now, there's many different other types of volume indicators besides volume itself. They all fall into volume, and they use calculations. Okay. Many traders use volume to confirm the conclusion of another type of indicator, such as the trend indicator. Sometimes market conditions or the lack of liquidity alone can temporarily drive an asset's higher or lower. However, these moves often occur on relatively low volume and can be short-lived. On the other hand, if an asset makes a big move on extremely high volume, that's a reliable signal that there's major buying and selling going on, and the move should be taken very seriously. Now, volume indicators include money flow index, Chaikin money flow, on balance volume, demand index, and force index. But we can't mix up volume, volatility, with momentum. Momentum is my favorite type of indicator. Even though MACD is my favorite indicator, momentum indicators are like speedometers. They tell you how fast or how strong this price movement is. And to me, if I'm a short-term trader, I want to know the momentum. Does that asset have the continuation or the strength or the momentum to drive it forward? Or is it falling down? Does it have the momentum to keep falling? Momentum indicators are like speedometers for traders. They show how fast an asset is moving in a given direction. These indicators are typically displayed as oscillators, which fluctuate above and below a baseline level to indicate how much positive or negative momentum an asset is experiencing. Arguably, the most popular of the momentum indicators is that of RSI, or stochastics. Now, these are also known as what we call bounded indicators. They fall in the category of bounded indicators because they are bound between a top number and a bottom number. So, for instance, like RSI or stochastics, no matter how you calculate them, will come in between 0 and 100. That telling you something. And on the scale, it's usually, and there's variations, but the area between 30 and 70 is what I call dead man zone. It's giving you no indication. But once that calculation rises above 70 or falls below 30, it's telling you that asset has become overbought or oversold. So if the asset moves below 30, that signals that the asset is oversold, and buyers could soon come in and drive the price higher. However, it's worth noting that RSI can sometimes stay above 70 or below 30 for prolonged periods, because overbought and oversold indicators don't mean they're going to change imminently. A market that's overbought can remain overbought for a while the traders decide what they're going to do. And there's others. There's CCI, Commodities Channel Index. There's Shande's Momentum Oscillator and Williams percent R, which is gaining popularity more and more by the day. But combining a momentum indicator with a volume indicator with a trend indicator can give you some very good understanding of the markets. Now, the next category is volatility. Volatility is very, very important because you have to understand the volatility of the markets, even if you're not going to use an indicator, because you have to understand where to put your stop losses. Where do you take profits? Can you afford to be in that market? What range should that asset jump between? Now, volatility is a measure of how large an asset's movement is in a given period of time tends to be. When an asset makes a large move in a short period of time, it is considered to be very volatile. Volatility is a very important indicator for traders because volatility makes it easier to profit due to price inefficiencies. Without volatility trading, opportunities would be limited. So we have, if you're trading in the stock market or if you're trading in Bitcoin, we have VIX indicators. These help us see how volatile the markets are, sometimes referred to as the fear factor. Then we also have Bollinger Bands, and we have whole classes on Bollinger Bands. And then we have envelopes. And these will all help us understand the volatility in the marketplace. So going back to our first category, which was trend indicators, we have three very popular types of indicators. As we talked about, we have moving averages. Then we have MACD, which falls into many categories, but MACD is moving average convergence and divergence. But look at where they fall. Both of them are lagging indicators. There's very few leading indicators when we come to trend indicators. Okay. But then we do have parabolic stops and reverse. They are a leading indicator. Now, this doesn't mean one is good and one is bad. Don't misunderstand. You have to understand what they're telling you. Are they in front of the market or behind the market? But you need to know which category they fall into. So remember, a leading indicator gives trade signals when the trend is about to start. Try to predict price by using a shorter period in their calculation, thereby leading the price movement. So the most popular leading indicators are stochastics, MACD, and RSI. Now they all fall into the groups of leading indicators. But this is why MACD becomes a little bit confusing, because MACD is a 4-level derivative. And there are many ways to use MACD. It's got 3 completely different interpretations. And this is why it's one of my favorite indicators, because it will cover most of the markets for you. Now, lagging indicators are those that follow price action. They give a signal after the trend or the reversal has started. Use them to determine a trend. The most common lagging indicator is a simple moving average. Now, these technical indicators measure the direction and the strength of a trend by comparing price to an established baseline. For instance, moving averages are used to identify trends and reversals, as well as to set up support and resistance. Moving average convergence and divergence are used to reveal changes in strength, direction, momentum, and duration of a trend. And like I said, MACD covers everything. So you should come to our class on MACD. Now, these indicators are designed to show traders and investors the trend or direction of the asset they are trading. The trend of an asset can be either downwards, upwards, or congestion or sideways. Trend followers are an example of traders who use trend indicators to analyze the markets. Okay. Now, these technical indicators, I'm sorry, I went past the slide too fast. Okay, so then we fall in the category we talked about before, momentum indicators. And these momentum indicators are broken into stochastics, CCI, and relative strength index, RSI. But look at what all 3 of they are. They are leading indicators, because they will mostly tell you that the market is overbought or oversold. So they're ahead of the market, but they can't tell you when that exact event will take place. So these technical indicators may identify the speed of price movement by comparing the current closing price to previous closes. Stochastics is used to predict price turning points by comparing the closing price to its price's range. And relative strength index measures recent trading strength, velocity, and change in the trend and magnitude of the move. The momentum is a measure of the speed at which the value of a security is moving in a given period. Momentum traders focus on stocks or assets that are moving significantly in one direction on high volume. For that, they use momentum indicators like RSI, stochastic CCI, Chanday's momentum oscillator, and Williams %R. So as you see, momentum indicators are essentially composed of oscillating indicators that are usually used to show overbought and oversold. What were they? What was that word I used earlier? Bounded indicators, because they were bound in an area that they always come out into, like RSI and stochastics are always 0 and 100. Now, volatility indicators, look at that. They're all on the right-hand side. Most volatility indicators are lagging indicators. So Bollinger Bands is a lagging indicator. ATR is a lagging indicator. Standard deviation is a lagging indicator. Of these, Bollinger Bands is one of the most well-known, most successfully traded indicators. And it will give you not only volatility, because the bands and the width of the channel expands and contracts with volatility. Inside that band, you will find where to put your exit points, your entry points, and will give you buy and sell signals. So it is a very universal indicator. So we also have a whole class on Bollinger Bands, so you should come to that class. So volatility is so important in trading that you can find several indicators that measure it or use it to generate signals. The volatility of the relative rate at which the price of a security moves up and down. A high volatility occurs when the price moves up and down quickly over a short period of time. And again, Bollinger Bands is a very good one. So it shows you volatility in the markets, as well as envelopes do volatility channel trains, projection oscillators. So volume indicators. Now remember, we talked about volume. Volume is crucially important. They measure the strength of a trend or confirm a trading direction based on some form of averaging or smoothing the raw volume. The strongest trends often occur while volume increases. In fact, it is the increase in trading volume that can lead to large movements in price. So the most popular one of these is on balance, OBV, or volume rate of index. Chaikin is one that's more for the stock market. So these technical indicators measure the strength of a trend based on the volume of an asset's trade. The volume of trades is a very important component to trading. It is, for example, used to confirm or infirm a continuation or change in an asset's direction. For example, money flow indicator is an oscillator tied to the volume that measures the buying and selling pressure using price and volume. Now, the reason we're talking about all these, because tonight we're here about technical indicators and chart patterns, or I'm sorry, candlestick patterns. Technical indicators as a whole are a secondary line of defense. They should not be your primary determination factor. Now, candlesticks are a charting system and will give you indicators of how price is moving. But they are not a primary, they are a leading system, but a candlestick move or a candlestick pattern must be supported by several other pieces of information. So your indicators can serve as that secondary line of support information, telling you what it is. But to be honest with you, your primaries should be the price on charts, the patterns developing on charts, support and resistance levels on charts, and trend lines on charts. So you have to understand what you're looking for and what's going to confirm. So think of technical indicators as your confirmation. So why use indicators? Indicators serve three broad functions: to alert, to confirm, and to predict. An indicator can act as an alert to study price action a little more closely. Okay? As an alert, it's not telling you to do anything. An indicator is hitting you on the back of the head. It's saying, go look at your charts. Okay. If momentum is waning, it may be a signal to watch for a break of support. Or if there is a large positive divergence building, it may serve as an alert to watch for resistance. Indicators can be used to confirm other technical analysis tools. If there is a breakout on a price chart, a corresponding move over the average crossover could serve to confirm the breakout. Or if a stock breaks support or a corresponding low, it could serve to confirm weakness. Some investors and traders use indicators to predict the direction of future prices. Now, this sums it all up. Indicators indicate. This may sound straightforward, but sometimes traders ignore the price action of an asset and focus solely on the indicator. And this is what I was just telling you before. It should be the reverse. Price action is your number one concern. And where does price action come from? The price movement on charts. Indicators filter price action like formulas. As such, they are derivatives and not direct reflection of price action. This should be taken into consideration when applying analysis. Any analysis of an indicator should be taken with the price action in mind. What is the indicator saying about the price action of security? Is there a price action getting stronger or weaker? So even though it may be obvious when indicators generate buy and sell signals, the signal should be taken in context with other technical analysis tools. Any indicator may flash a buy signal, but as the chart pattern shows a descending triangle with a series of descending triangles, it could be a false signal. So your primary thing should be looking at your charts. And on those charts, you might be looking at candlesticks, or you might be looking at bar charts. You might be looking at price patterns developing, like triangles, head and shoulders. But it's ultimately this price action on a chart. And indicators are either laid on your pricing chart or laid below your pricing chart. As always, in technical analysis, learning how to read indicators is more of an art than a science. The same indicator may exhibit different behavioral patterns when applied to different stocks or assets. So I've got some live charts ready for us. So let me pull them up so we can get away from some of this boring stuff. Now, I'm not here recommending any assets to anybody. Even though we're looking at several different charts tonight, I just pulled these charts up because they are interesting as of today. But I'm not making a recommendation. You notice we're looking right now at Bitcoin dollar. This is a candlestick pattern chart. We're looking here at the Euro US dollar. Again, candlesticks. And then we're looking at Bitcoin Cash, and again in candlesticks. But what are we looking at? Let's not worry about price. Okay, what we're looking at are our analysis tools. Here we're looking at trend lines. Okay. Then we're looking at support levels and resistance levels. We're looking at an ascending price channel. This is the price channel. Okay. All of these are taking place on charts. But what are we using for confirmation? We're looking at our candlesticks as far as our swing lows and our swing highs. Okay. And our candlesticks combined with volume, price action, support and resistance give us a very specific story. Then we're looking at our indicator to give us some type of confirmation. Here we have a very positive, what's called divergence. The highs on our indicator are moving in a downtrend, while our price is moving in an uptrend. So our indicator is moving in a diverging direction from our price trend. Now what we would be doing is we'd also be looking at our candlesticks to give us a pattern, to give us one of the known candlestick positions to indicate whether we got a bearish engulfing, a bullish engulfing, a harami, to tell us what the markets are expecting us to do. And by being able to read these candlesticks and use these in conjunction with our other tools, we can make good trading decisions. So we can just, let me get my marks off the chart here. So again, here we have trend lines. We have actually here, we have a formation of a triangle. Okay. We have lots of information. We have our Fibonacci levels for our support and resistance levels drawn on there. But because our ultimate comes down to price action on the charts to decide whether what we're going to do, we need the charts to tell us something. We need price to tell us something. Okay. We have our moving averages on here, and we have a 100-day and a 200-time period moving average, and we would be looking for crossovers or convergence. So like here, we got a beautiful crossover, which gave us the price moving back into this uptrend. Here we have nothing. We're waiting for something, and we're looking for something to confirm price. Right now, we're looking at for the euro about a 114.30 level. It's right now on our Ganfan support level. We're looking for a Fibonacci level, and we're sitting back waiting tight. So the best indicator would be possibly a pattern developing in our candlesticks. But you don't know what patterns we're looking for yet. Now, candlesticks have 32 different patterns. Okay. So that's a lot. Okay. And you have to learn them, but there's 16 of the most popular patterns. And these can be found, but you have to understand and know what they are, because putting them on the charts is very time consuming. And there are ways to do this easier if you know what you're looking for and how to interpret them. Now, the fact is, you need to know what you're looking for. So let's go back to my PowerPoint, and we're going to sit back and talk about the most popular candlestick pattern. So hold on, let me pop up my... So there are, and candlesticks, we actually have a 3-week course in candlesticks. You're not going to master candlesticks and using indicators on a chart in a 1-hour class. It takes me one hour just to go over the different things between a doji and a Hammurabi and all the different types of positions, star position, and everything else. And tonight we're going to look at the 16 most popular patterns on the chart. But to learn the interpretations is a little bit time consuming, but they fall into 3 categories of candlesticks. Okay, and I didn't make up this chart. This is a standard chart. Somebody gave them a nickname of Lonesome Cowboys, 2 for Tango, and three Musketeers. I just call them singles, duos, and triples, because all that they talk about is Lonesome Cowboys are standalone, are single candles. And what does that shape and size of that candle tell you? 2 for Tango is the combination of 2 candles next to each other, and what are we looking for, and what will that combination tell us? And 3, which is the strongest patterns, tell us that the three most recent candles in these certain positions, when they do these certain things, tell us something very important. So there are 16 popular, well-repeating, or important shapes you have to learn, or important candlestick patterns you have to learn. And these are very important that you must master. Now, hold on one second. I'm going to try to give you a handout. Just give me a second here to... Uh-oh. I'm just... Sorry about that. I don't know. Give me a second. I'm having a problem with my... Okay, now... Okay, there we go. Give me a second. I'm trying to give you a handout that I think I can send to you, which will have these 16 patterns. I'm going to see if I can do it in the middle of a class. So just give me 1 second to... Just hold on 1 second. I think I can do it to you in the middle of a class. No, I'm sorry, it's not letting me do this. I'll find a way to send it to everybody through email. Tomorrow, the next day. So now why is it? Okay, let me just get back to the slide we were at. Okay, so watch for an email in the next couple of days from investing.com, and we'll get a handout sent to you. Okay, so the 2 of the most popular signals are called bullish engulfing and bearish engulfing. And if the pattern appears at the end of a downtrend, it would comprise of a small red body candle followed by a much longer green body candle. This is called a bullish engulfing. Bearish engulfing is exactly the opposite. For every pattern in one direction, there's the exact opposite. It shows, if it's a bullish engulfing, that the bulls have taken complete control of the marketplace. Because what's happened is You have price moving down, so it meant the bears were in control. Price is going down. And then you have the bullish engulfing. And what the bullish engulfing does is the whole body, the next body is larger than the previous body in the opposite color, but the entire previous move is engulfed within the body or within the size of the next candle. So that's telling you the bears lost control of the market and the bulls took control. Okay. In a bearish engulfing, you have just the opposite. And what that's telling you is that trend is now ending. Okay. Then we have another one called bullish tweezers. Bullish tweezers is very rare, but when it happens, it's very important. Okay. And bullish tweezers look just like the name. A bullish tweezer means it occurs in the end of a downtrend, and you'd have one body of a candle with no upper wick, and the body of this candle and the next candle would be virtually the same, and both of the shadows, the wicks going down, would be about equal length. So it looks just like a tweezer, and they would be an opposite color. So you have a bullish tweezer, and that's telling you the market's moving into a bullish trend from reversing from a bearish trend, or you have the exact opposite. So some of these are a little bit confusing, but you have to learn them. Okay. And like I said, there's 16 different patterns. Okay, we have morning stars, evening stars. Okay, and then we get to the triples, which are more important, and then we have 3 white soldiers and 3 black crows. And these are trend reversal patterns. And when they occur, so the 3 white soldiers are like 3 steps in the opposite of the trend. So in a downtrend, you have 3 steps going up. So when you have 3 bullish candles moving upward, and each one moving higher than the other, tells you that previous downtrend is completely over, and now we've moved to an uptrend. When they occur, they're very important because they are very rare, so therefore that means they are very valid signals. And then we have 3 black crows, which is just the opposite in a downtrend. Then we have the 3 inside up, 3 inside out. And these are 3 patterns that are hard to explain. Okay. And again, they're trend reversal patterns. But when you see them, that you know you should be paying attention. Okay. And when you see them, it's actually telling you it's time to move into action. So the thing is, these are only a couple of the patterns. You should know all 32, and you're saying, damn, how am I going to spend all of my time? I don't have the time to dedicate this. How am I going to find these on charts? What am I going to do? Well, the fact is, number one, you don't have to remember what the names of the candlestick patterns are. You just have to know when you see them what they're trying to tell you. Number two, thanks to computers these days, you don't have to sit there and look them up on your charts. Okay, and I'm going to show you 2 simple ways that you can combine candlesticks with your indicators without doing much sweating. So let me bring the charts back up here for a second. Okay, and we're going to go over here to my Euro US dollar chart. And you notice on this chart, on the top portion of the chart, on the price, and let's change it over to candlesticks so it's easier for you. Okay, now we have all the candlesticks on the charts. See them all? And you see where it says bearish harami all over the place? It says bullish harami. It says bearish engulfing. Well, the fact is today, you don't need to go locating these. The computers systems will pull these out for you. You just got to know how important they are and what they're trying to tell you. So you have to know what, because you don't have time to go looking them up. When you see a bearish harami, that is telling you something important. When you see a bullish engulfing, what's it trying to tell you? Now, to get these on your charts, okay, a lot of charting services offer them very easily, and we just simply go up here and we can pick out which patterns we want, which we think are important, what colors we want them, and set them right up on our our patterns. And means you don't have to spend hours searching these out. Okay, and you can set them up. You can just tell them when you want. But the next thing is, if you go to investing.com, and click on the asset you're looking at. And there's several ways to get this, but you can click on the asset you're looking at over here on the right hand side. We're going to pull up our charts with all of our assets, and we're going to go up here to chart and under technical, and we're going to click on candlestick patterns. And investing.com is now putting them on your charts for you also. And we'll show you exactly where they're happening and give you the explanation what they're for and why they're there. You can change your time frames, your hours, and everything else, and then you can just scroll down and you can see right on the charts exactly what patterns are appearing on the charts. So we see that 14 candles ago in a 15-minute time frame, we just finished a 3 white soldier pattern. And you can see it right here on we just had another one develop, but here is the perfect one that happened here 14 candles ago. And so, but we have a choice to see completed pattern, and completed patterns are important, but you should also see developing pattern. So if you click up customize, you can pick out the time frames you want to see the patterns. Completed patterns or emerging patterns. Emerging patterns are important. I don't want to see any one-star patterns. And in most cases, you may not want to see 2 or 3, only 3, and then you click it and you apply it, and it will give you all of that information. So now you've avoided all of that difficulty of having to search out the candlesticks, figure out what they mean, where they're developing, because again, as the charts are moving and you're trading and it's developing, that's a little bit difficult. We can also go up to our streaming charts. I'm sorry, went to the wrong place here. If we go up to technical analysis and click on candlestick patterns, we can then customize every asset we want to watch, what we want to watch, and they'll tell us each pattern, the patterns developed for each individual asset that we've selected in those price variances in which we want to see. So you can customize this all you want, and you don't have to spend your hours looking at candlestick charts. You can get your moving averages, and you can also get all the full technical analysis to place on your charts. So it makes it easy for you. So anytime you want, just go to candlestick patterns. Okay. Or the other way is to go to your live charts. Okay, and you can drop your candlestick patterns right on your live charts and do the rest of your analysis right there on adding your other indicators and oscillators right there onto your charts and be able to do your full analysis right here on investing. But the nice thing about it is it doesn't matter what charting service you're using. If you're trading on a Vexos platform, you can use the alerts here just to alert you when that pattern is developing, and then go over there and go onto Vexo and use their advanced charts, and you don't have to waste your time seeing what's happening. You've now got it, because the hardest thing is tracking many assets and keeping track of all of these patterns, because you have lots of patterns that are developing. So you can either use the ones on TradingView, and you get these on TradingView by just going to indicators, and you'll go over here to public library, locate on the scripts, the script you want to use, and it will do the calculation. So we're going to scroll down here and look for candlestick patterns identified. And then all we have to do is, see, now it's giving us everything under the sun. As you can see, it's a mess. So then we go to format and we decide which ones we want to see, how important they are, what colors we want to see them in, and how we want to see them above or below. You can put them all with just dots and dashes and have them on your chart. So you decide, so you can decide you only want to see the top level charts. But this allows you to combine your candlestick patterns and your candlestick charts with the rest of your technical analysis, and by adding on your indicators at below. So hopefully this gave you some indication or some food for thought of how you can use indicators, what indicators you should use, how you combine this with price action on your charts, as well as using your candlestick patterns to predict price movement. So remember, I'll find a way to get you sent the email with the candlestick charts on there, so you'll be able to get them in the next day or two. And the first thing you have to do to use candlesticks is learn all of those patterns and what they mean. Indicators, pick a selection of indicators. Pick ones you like. I've been using MACD since the 1980s, and it's taken me a lot of years to become an expert at it. For instance, I don't use RSI or stochastics, not for any reason they're good or bad, but from there I use Bollinger Bands, and just learn to become an expert at one at a time and build your trading system. So you learn how to use your support and resistance, learn how to use your volume, and always use your trend indicators. Learn how moving averages work and understand them thoroughly, and before you know it, you'll be trading successfully. So have a very good night. Remember, this class has been recorded. You can access it on investing.com. And thank you for supporting Alvexo, and I hope we learned something tonight. Have a good evening, and we'll talk to you again real soon. Good night now.